invest in another company? Do you know that one company can invest in another company? Corporate investments.
Yes, please. Yes, please. We do.
Yes. So let's say you can take Guel. Guel can invest in STC. Okay. Yes. Or Unilever can invest in Enterprise Insurance. Now, if one company invests in another company and the investments, so when you invest in one company, it means you are going to buy shares in that company. So if you buy the shares, assuming the company has 100 shares, then if you buy the shares in that company and the amount you bought is, or the amount you invest in is 60 out of 100. When you want to make a decision, who has control, who has power, or who can decide what should happen when it comes to voting?
60% shareholding.
So the one with the 60% can decide, because it is by voting. Then the one with the higher votes can decide. Now, in accounting, if that is the case, the one who has 60% share can add the financial statement of that company that it has gone to invest into its own financial statements. So let me use, someone should give me a company. So please give me practical companies so that I will use them. 2 companies. Mention anyone you want.
Nestle, Nestle PLC.
Nestle company. So let's say Nestle, right? And which other one?
Fan Milk.
Farm Milk. So Nestle can, if Farm Milk is looking for investors, Nestle can go and invest in Farm Milk. Then Nestle invests 60%, or Farm Milk total shares are 100. Nestle buys 60 shares. So Nestle has 60% investment in Farm Milk. Now, Farm Milk will prepare its financial statements. Then Nestle too will prepare their own financial statements. Then there's another third leg of financial statements. So Nestle will have to add the financial statement of Farm Milk to its own, and it becomes consolidated financial statements. Right? It becomes consolidated financial statements. So the condition is that you must invest more than 50% in another company before you can consolidate. That is the first rule. You should have more than 50% before you can consolidate. So you have 51% all the way to 100%. You are qualified to consolidate. Okay. Now, the Nestle becomes the parent company. Then the Farm Milk becomes associates. Sorry, it becomes it becomes what company? Subsidiary. Then if Nestle and Farm Milk, okay, Nestle has 50% in Farm Milk, and then maybe another company also has 50% in Farm Milk. Nestle cannot consolidate because it has not reached the threshold of more than 50%. So they become a joint venture. Now, if Nestle has 60% in farm milk and another company, let's say Unilever, also has 30% in farm milk, then Nestle becomes the parent, Unilever becomes the associate. Then maybe, so 60 and 30, 90%. And maybe there is another company, let's say any other company that has 10% in farm milk, that company also becomes just mere investor because it is having just 10%. So the rule is that if you have more than 50%, you become the parent company. If you have less than 50%, but not less than 20%, so that is 20 to 49%, you become significant influence, okay, or an associate. Then if you have 50-50, you become joint venture. If you have less than 20%, you become what? Just mere investor. And this standard, this topic consolidation is governed by key standards, 4 key standards, IS 27, separate financial statements, IS 28, investment in associates and joint ventures, IFRS 3, business combination, then IFRS 10, consolidated financial statements. Now, even though these 3 standards clearly guide consolidation, there are other standards that you would also need when you are preparing consolidation. But these 4 standards present how consolidation should be done. Now, let's look at some of the terms. Consolidated financial statement, as I indicated earlier, when you add Unilever financial statement, their individual financial statement, to farm milk financial statement, the two combined as one become consolidated financial statement. So you add the assets and liabilities of the 2 companies, income and expenditure of the 2 companies, then the resultant figure becomes consolidated financial statements. Then as they stand on their own, the financial statement for farm milk and the financial statement for Nestle, okay, they become separate financial statements. So the statements before you add, they are what? Separate financial statements. Then the one who acquires more than 50% becomes the parent. The one that is under control becomes the subsidiary. Now, when you put the 2 together, okay, parent plus subsidiary together, they become a group. So Nestle and then farm milk, they are now together as one entity. That entity is called a group entity. We also have what we call holding. Please, if you have any question, you can let me know as I proceed. We have what we call holding company. So these terms, you need to know them. So holding company here, the company assets that the only assets they have is in another company. Okay. Like those days, your grandmother used to keep your money. All the money, or your mother used to keep your money. Okay. All the money you have is in is with another person. So the company that exists, but all the assets the company has is in the subsidiary, or they are in another company. Okay. They are in another company. The company just exists as a name, but all that they are in another company. Okay, so that company becomes a holding company. Then control, as I said, control comes mainly as two reasons. But the major one is that it should be able to control, have shares more than 50%. So if you have shares more than 50%, then you exert control. Okay. Let me use right. So if you have shares more than 50%, you exert control. So in that case, because you have more than 50%, you can't decide what is happening in the company. The second one is that you may not have shares more than 50%, but you are exposed or has the right to variable returns. So in this case, you have the right to decide. Though you are not having 50%, but you have the right. How do you get the right? You can get the right by agreement. The contract you enter at the beginning, your contract says, okay, you may have 45%, but you have the right to control. Government normally enters into that agreement with companies. The company may have more than 50% control shares. The government says, oh, I have the right to decide whatever it is in the company. I have the right. In that case, the company cannot be consolidated by the other company who has more than 50%. But you can only it can be consolidated by the one who has the right. So mostly this one, we don't really see them that as exams question. You always see more than 50%, but it's also possible that a company can consolidate without getting the control of 50%, but it must only be on the condition that the company has the right to do that. Okay, then wholly owned subsidiary and partly owned subsidiary. We say that you should be able to control more than 50%. But if you are able to control exactly 100%, then the subsidiary becomes a wholly owned subsidiary. But if you control between 50, okay, and then 100%, then the subsidiary becomes partly owned subsidiary. So 50 between 50 and 100%. So from 51 all the way to 99%, then it is a partly owned subsidiary. All right, non-controlling interests. So if you control 60%, the 40% is not under your control. So that 40% is for another group of people or another group of investors. Then those investors become non-controlling investors, or their interests become non-controlling interests because they cannot control the company. So therefore, the 40% becomes NCI. NCI is very important in our calculation here. So they don't have any power to control, to consolidate, but they are also part of the interest. They also have interest in the company, and they are part of the company's investments or investors. So they become NCI. Power comes in Ghana. We know that for you to become the controlling party, you need to gain power. How do they gain power in Ghana to become the controlling party and rule the country?
% 1 vote.
Yes, so 50% plus one vote. 50% plus one. 50% plus one. That is it. So you need a vote of 50% plus one. So in the same way, if you need you need to uh, control. When we say control is 50% above 50%, then it is similar to power. So you gain power when you are able to get control. Okay, so in that case, with your power, you can direct all the activities that is going on. You can decide what to do. Okay, you can do whatever you want to do with that power. So that is it. You cannot gain power if you don't have control of more than 50%. Alternatively, it has not also been given to you through contracts. Okay, that is it. So those are the things. So power arises when you have 50%, okay, of the votes. Then also through contractual arrangements, as we saw in the other point. Then also due to dominance, okay, of the business, someone is dominating, so the person has power. Okay. Now, significant influence, as I indicated, you cannot consolidate, but you still have an influence which is significant in decision making. So when you are holding between 20 to 49, you have significant influence. But anything less than 20, you are just mere investor. Okay, you are a mere investor. All right. So you can look at the indicators of significant influence. Now, with a significant influence, you have between 20 to 49. Okay. Then how do you treat that? You know that with consolidation, you should have 51% and above. With a significant influence, you have 20 to 49. How do you treat that? We treat it using what we call equity accounting. Equity accounting. Okay. It is very simple to treat. To, so you take the person's profits. If you invest in company B, and then company B makes profit of 20,000, and you have your investment as 30%, which is significant, or is considered as significant influence. So what you simply do is to take 30% of the 20,000. That is simple. That's all. That's what that treatment is what we call equity accounting or equity method. So what you do is take 30% of 20,000, okay? Then you get maybe 6,000. You add the 6,000 as your profit for the year, because you have another investment somewhere. You have another investment somewhere, which is giving you 6,000. So you add it to your profit after ascertain your profit, add it to the profit. Then you because they haven't paid you, the investment in that company will increase. So you go to your assets where you have the investment of 20,000, you add it to the 20,000, you get 26,000, and that become the equity method. Joint venture, as I indicated, where you have 50-50, 50-50 in shares, then it becomes joint venture. So these are the terms you need to know about consolidation. Please ask your questions before we move on. If you don't ask, I'll ask you. Ask your questions. If you don't get something, say it and let me explain it again. Yes, madam.
Please, can you explain more about the equity matrix?
I shall explain more on the equity method.
Yes, please.
Okay. It's very simple. It's very simple. So, let me say, is it Rita? And so let's say Rita and Juliana. Rita has been taking goods from China, right? And Juliana say, okay, I want to give you money so that when you take goods from China and come and sell, the profit you get, you give me some. Rita needs $20,000 to do the whole business. Okay. Then Juliana gives Rita $8,000. Okay. I hope you are following the scenario.
Yes,
How much does Rita need as for the business, the whole business? How much does Rita need?
20,000.
How much did Juliana give Rita?
8,000.
Can't Juliana control Rita or not?
You can't control her
Why?
because the money that she gave her is not that much to control her.
It constitutes how much of Rita's business? How much does it constitute? So what is the control? Or what is the percentage? Hey, you people. You don't have calculators. I said for accounting these courses, if you don't come with calculator, then you cannot partake. What is the percentage of Juliana's share in Rita?
40%.
40%. So, Juliana, what influence is Juliana having on Rita? Is it control,
no,
significant
no.
influence, or
Yes,
mere influence?
it's no control, it's significant.
Significant influence. Okay. Now, if Rita go to China and bring the things and sell the 20,000 and sell, okay, and make profit of $5,000. So Rita makes profit of $5,000. Rita, how much will you give Juliana?
I'll work 40% of the profit.
How much will you give Juliana?
I will give her 2,000.
Yes, so that is what we call equity method. Are you okay?
Yes, sir.
Okay, so that is.
Yeah.
So any other term you want to know? So if you look at many of them, consolidated financial statements. Yeah,
So,
go ahead.
please, I want to find out what if there is a loss? Will it be shared among them?
Daniel, answer yourself. Daniel, what will you do if it's a loss?
Yeah, I think it should be shared, but then what if the loss came as a result of the buyer? The inaction and actions of the buyer.
How do you know it's the inaction and actions of the buyer?
Maybe he bought it at a price he's not supposed to. Or maybe there was some form of carelessness somewhere.
When he made a profit of 2,000, this in the 5,000, did you say, did Juliana say she will not take the 2,000 as her share?
No, please.
It's possible Rita could have made profit of 3,000. Okay.
Okay.
Is it not possible she could have made profit of 3,000 and give Juliana 1,200? But she made profit of 5,000 and gave Juliana 2,000. So what are you talking about if there is a loss? Also remember, when she made profit of 5,000, she gave herself 3,000 based on the proportion of 60%, and then gave 40% to Juliana. So do you think she enjoys making loss?
Okay, understood.
Mhm.
Doc.
So in business, there's nothing like that. That is what is the name of that term? What's the name? What's the name?
That's equity financing.
So what's the name? Look at it. Here is what? Equity.
Equity.
Yes, equity.
Yes. What is equity? If I make loss, we enjoy. If I make profit, we enjoy. Is that not the
Okay.
case?
Okay, thank you.
That is it. Any other term you want to? I can bring this as your quiz. In your quiz, it will come. So you better understand them before we go. It may come. Let me put it that way. It may come. Your exams. Explain the following. Okay. Power. NCI. Equity method. All right. I'm sure you are okay. All right, so let's move to consolidated financial statements. Now we are saying that if you acquired more than 50% of the shares in another company, you should do what? You should do what?
You should consolidate.
Yes. But there are exceptions to that. Okay. There are exceptions to that. So these are the exceptions to consolidation. These are the exceptions to consolidation.
Doc,
So there are 4 exceptions. Yeah.
please, can you kindly zoom the text for us?
Yes. So I want you guys to read, discuss it among yourselves, these exceptions, Then you start from here up to here. So someone should read and you discuss among yourself how you understood it. But it should not be more than how many minutes? 8 minutes. 1 point for 2 marks. 2 minutes. Yes. So please, you can start. So Daniel, read.
Okay. A parent need not present consolidated financial statement if it meets all the following conditions. 1, it is a wholly owned subsidiary or is partially owned subsidiary of another entity, and all its other owners, including those not otherwise entitled to vote, have been informed about and do not object to the parent not presenting consolidated financial statements. 2, its debt or equity instruments are not traded in a public market, that's a domestic or foreign stock exchange, or an over-the-counter market, including local and regional markets. 3, it did not file, nor it is in the process of filing its financial statement with a security commission or other regulatory organization for the purpose of issuing any class of instruments in the public market. And 4, its ultimate or any intermediary parent produces consolidated financial statements that are available for public use and comply with IFRS. All right. Dog, please, it's okay. Is it okay now?
Oh, you just read.
The last one there.
You
Okay.
know, you just read 1 point, okay, and then you call on your people to bring their contribution. That's what I want you to do. I don't want to be part. Is that okay?
Okay, dog.
All right.
Okay, so members, over to us. And we are to explain the exceptions to the rule of consolidation. And so, can we have someone to explain the first one, the first point for us, please? Okay, Rita, are you there?
Yes, I'm here. I'm reading over, so give me some seconds.
All right. Danny Life, Daniel Minta,
Just joined though, so I'm
Abukari,
not ready.
Anthony. All right, you are all there, right? You're active. All right. Juliana Pimpoma.
Please let me share my idea.
Okay, Rita.
So my little idea is I understand as if it is wholly owned or is partially owned by another entity. So it means the parent company it says self-owned by another company. So if it's only owned, or the other owners, including those without voting rights, they must be informed and agree that consolidated financial statement will not be prepared. And this helps to protect the interests of the minority shareholders. That's those whose say are minimal. So they must all come on board to agree that we are not going to prepare the financial statements. Please, that's my little understanding.
Okay, Rita, thank you very much. Please, anybody else to help break it down? Or shall I mention names? Please, Delali, are you around? McLean, hey, sorry, that is Senna, Daniel Minta, Nyaku. Okay, to my understanding, with regards to the first point, I think it's more about ownership and then approval. If so, the parent itself must be a subsidiary of another company. That is to be exempted. And I think members must also agree to whatever has to be done before it must be done. All right. So that is my point.
Hello.
Yeah.
Okay, so with the first point, what I also think is that the parent is the one who owns the company, and then the subsidiaries. Okay, they also have the parents have more shares, let's say, and then the subsidiaries, this share is not uh, not much. So when they are preparing maybe the consolidation, the the owner of that company, okay, because he is because uh, he is into it. He does not the owner does not have to object to maybe the preparation of the account. That's the consolidation. That's what I think. So, example, if maybe a that as we cited an example, maybe if a company like Farmers
Okay.
is owned by maybe let me say Danny, and then that farmer company is also owned by what another company. it means that the farm oil company, if they want to prepare the consolidation for the two companies, no, farm oil company does not need to prepare any financial statement, since maybe it is the parent company who needs to prepare that statement, not the subsidiary one. That's what I think.
Okay. Please, any other person to digest it for us? All right. I think it's very clear at this point that the first point emphasizes on the ownership and the approval that has to be given before it will be consolidated or not. And then can we move to the second point?
Yes.
All right. Its debt or equity instruments are not traded in a public market, a domestic or foreign stock exchange, or an over-the-counter market, including local and regional markets. Okay, so here, if I am to break it down, it means that the company's share or its debts shouldn't be something that is traded in any public money markets. It shouldn't be traded in any public market. Or any stock exchange. Please, any understanding about over the counter, if you can? What does it mean?
Please let me add my little understanding.
Okay.
Based on your explanation. Now, I also understand that the company shares are not listed or traded on any public stock exchange, as you rightly said. And since it is not raising funds from the general public, there's less need for separate consolidated financial statements. That's my little understanding.
Oh, okay. That's great. Please, any other explanation?
Okay, so what I also think is that if it does not meet the requirements of the public stock exchange, in the course of that, it shouldn't be public in the public stock exchange. That's my understanding. Yeah.
Okay. All right, let's move to the third one. It did not file, nor it is in the process of filing its financial statement with a security commission or other regulatory organization for the purpose of issuing any class of instruments in the public market. Okay, so here I can see that there are some clauses. That the first one is that it has not actually done any filing, and then it is also not in the process of filing its financial statement with any security commission, let's say Ghana SEC, or any regulatory organization, and for the purpose of, for example, issuing shares or any other instruments, class of instruments in any public market. So, for example, let's say we have Unilever as a company, and this company is not in the process of maybe floating shares in, filing to do that, or giving, issuing any type of financial instruments to the public. So I think that's my take.
Hello.
Yes.
I think one of the conditions for consolidating financial statement of companies is that the company should file its document to the Security and Exchange Commission. So if you haven't filed, you're in the process of filing, it means that it has not yet been approved, and therefore you can't consolidate. That's how I understand it.
Okay, please, can you hint on it again? I didn't get the last statement.
I said that one of the qualifications for companies to consolidate their accounts is that you have to file your documents to the Security and Exchange Commission. Let's say if next year you want to close shares, I think this year you must file your financial statement and document to the Securities and Exchange Commission for them to approve, so that next year you can consolidate your account. But if this has not been done, or you're in a process of doing that, then I don't think the companies qualify to consolidate their accounts.
Okay. Okay. All right. So please, any other? Okay, then let's move to 4. Its ultimate or any immediate parent produces consolidated financial statements that are available for public use and comply with IFRS. Okay, so with this 4th point is looking at the parents reporting exits. So the ultimate or the intermediary parent company produces consolidated statements, and this statement must be publicly available and comply with IFRS, sorry. So with this one, it's like the company should, before a consolidated financial statement, let me put it this way. The company may have other intermediary parents producing other things. Let's say the same company, but it have other parents, subsidiaries, for example. And let's say they have also have they've also had they've also done this, been able to consolidate their financial statement with others. So in this case, I want to understand the parent company, is it the same as the ultimate, or I'm confused?
Yes, I think the parent company is the ultimate parent.
Okay.
Hello, Danny.
Yeah.
Yes, so I think it's the same as the parent company, but to my understanding here, I just want to add more to your own. You see that the parent company should be able to prepare the financial statement in accordance with IFRS statement. That is international financial reporting. It should be in accordance with it so that it will be available to the users of that statement so that they'll be able to go through and see if the financial statements agree with the standard one. So as the parent company, you must be able to prepare that financial statement that moves along with the IFRS, and then you make it available to the users to also look to it. Okay, so that's my understanding.
Okay, so it means that if the parent company or any intermediate parents have produced a consolidated financial statement, then it means that they are not, they are exempted from. We are speaking about this with reference to a parent need not present consolidated financial statement if it meets all the following conditions. So can you please link it for me to get it clearer?
Hello.
Hi.
Okay, actually, you speak when you finish.
So, Auntie Rita, you come in. You come in first so that you don't mind.
I wanted to also say that with the 4 points, my understanding is that if a company belongs to larger group and the higher level parent company already prepares consolidated financial statement based on the standard for the whole group, the lower level parent company does not have to prepare another set of consolidated financial statements. Example is that if, let's say, company C owns 100% of another company, let's say company B, and then company B also owns 100% of company A. So three companies now. So the company C is the ultimate parent, and the company B is an intermediate parent, and the company A is a subsidiary. So if company C prepares IFRS consolidated financial statement that include both company B and A, then company B may be exempted from preparing its own consolidated financial statements. That's my understanding.
Okay. I think it's clear. If that's the case, I think it's clear.
Which I you know, okay.
Yeah.
Okay.
All right. Please, any other inputs so that we inform our indefatigable doctor to come? All right.
I think it's all. So let's call Dr. to throw more light on it for us.
All right. Please kindly message him if he is not in the group now to alert him.
I'm there. I'm there. I'm hearing all that you're saying. So you have done well. That is it. So I don't think I should add something more, except to say that it is one of the examinable areas. You should not come to write exams without knowing it. Okay.
Okay. Please, with the first
So
point.
we
Hello, Doc.
proceed. I don't need to talk about it. You have
Hello,
talked
Doc.
about it.
Oh, say. So
Which
what
one?
that
Hello, Doc.
Yes, madam.
Please, with the point one. Please,
Yes, I
to
can hear you. I can hear you.
with the point one. With the first point, the I.
Yes,
Throw
Juliana,
more
I
light
can hear
on it.
you.
Yes. I said that with the first point. Please throw more light
Mm-hmm.
on it for throw more light on it for me.
Okay, so we are saying that you can. All right. So we are saying that as a parent, you don't need to do consolidation if it is a wholly owned subsidiary. Okay. So if you are a wholly owned subsidiary, you don't need to do consolidation. So let's say whether wholly owned or partly owned, okay, you don't need to do consolidation. Let's say A owns B, B owns C, right? And then, so none of them can do consolidation except the parent company. But you need to inform B that you want to consolidate B, and you need to inform C that you want to consolidate C. And then A says I'll consolidate B and C. B didn't object. C too didn't object. If they don't raise legal question about the consolidation, then you go ahead to consolidate. Okay. So you need to inform them. But if they raise legal question, you cannot consolidate without resolving that.
Thank you.
So you have to inform all of them. Okay, including those who are entitled to vote. So it should not be a surprise thing. Just get up one day as if you are a dictator and you want to consolidate, add everything because you have more than 50%. And they raise issues about it and you still ignore it and go ahead. If you ignore it and go ahead, they can use this clause, okay, to win you at the court that they object to your consolidation, and then you still went ahead to consolidate. Is that okay?
Yes, Doc.
Yes, though.
Okay. So let me send you the format before we move on there. Just a minute.
Hello, Doc.
Need to send you the format.
Hello, say.
Yes, madam. Yes,
So,
madam.
please, the third point, and you also go throw more light on it for me.
Okay. Yes, so I'm coming. Let me send this and then come back to the tablets. Therefore, consolidation format. All right. So the third point number 3 says it did not file. Okay. You know, it's a requirement that you must file your financial statements with SEC. Okay, SEC. You must file it. So if you do not file, okay, or you are not even in the process of filing your financial statements with SEC or other regulatory organization, maybe some are not required to file with SEC, but with other regulatory organizations. So if you do not file it, or you are not in the process of filing, and you want to still go ahead and issue financial instruments, or you want to trade with the public, then you cannot do that. So you must file. If you don't file your financial statement, you cannot consolidate. You must file your financial statement, meaning you must present your financial statement to SEC. Okay, Security and Exchange Commission, SEC. They regulate how you can go and trade on the stock exchange, how you can solicit for financial instruments, meaning you can go to the bank and take loan, long-term loan. You can go to the market and then acquire a long-term loan, okay, or you can go to the market and also give out money in terms of long-term loan, to someone. So financial instruments, we have financial asset and financial liability. Okay. That is it. So that is it. So it's just about filing your financial statement or it's SEC. Okay.
Okay, thank you.
Okay.
All
Okay.
right. Mhm. Okay. So that's fine. That's fine. Then the question that arises, we say that we can consolidate companies. Is that not what we are arguing? That we can add one company to another. Somebody give us example where we have Nestle and Farm Milk. And then the question is, what if the people are not doing the same thing? If the two companies are not into the same business, maybe one is let's say if you take Unilever and then you take another maybe a mining company, they are not doing the same thing, or a Greek company, they are not doing the same thing. You take communication company, they are not doing the same thing. Can you still add them together? Can you still add them together when they are not doing the same thing? In your mind, can you still add their financial statements together if they are not doing the same thing? In your mind, yes or no?
No.
So I think you prefer separate accounts for each department or something, even though they are
Juliana,
you
you
are.
have to speak to your microphone.
Hello, sir.
Julie, you are far away from your listen.
Hello, Doc.
Yes, what were you saying?
I was saying
Yes, we can
why
hear you now.
I think you can prepare separate accounts for them. even though you have consolidated, the company has come together to work, you can still you prepare separate accounts for them since they are not doing the same, they are not using the same product. That's my idea. You prepare different financial statements.
Okay. Now let's avert our mind to the format of trading profit and loss account. Yes, so let's start. What is the first thing in the trading profit and loss account?
Revenue for sales.
Revenue or what?
Sales.
Okay, then what do you do again?
We less our return inwards to get the net sales.
Okay, okay, what do you do again?
You less cost of sales.
Everybody, not one person. The less cost of sales. What come under cost of sales? You are teachers, so we are going to teach you. So put it in your mind, like let it be in your mind. Okay, not only on paper that you are. So yes, what comes under cost of sales?
Opening inventory.
Opening inventory. What is next?
We add
purchases.
Purchases. What is next?
We less return outwards.
You less closing inventory. Then you get what?
If you less, you are going to get cost of sales.
Good. Then what do you do next? We are doing it to the end, to the profit side. So what do we do next?
We less the cost of sales from the net sales to get the gross profit.
Or loss.
So less cost of sales from net sales to get gross profit. So what do we do next?
If we have
add other income.
Add other income. Then what do we do next? Abukari?
We less operating expenses.
Okay, we let less all the expenses. Can you mention some of the expenses?
Hello, Doc.
Yes, Abukari, you have something? Yes.
Yeah.
Yes, sir.
I think we left one item, that is the omission. So when there is
which item?
like I'm talking of omission. So when there is omission, we add it before we get the net sales. So that item, it has been tricking a lot of students when I was in SHS.
Omission of what?
You said omission or
sales.
commission?
Yeah, omission of sales, omission. That item, omission. OM.
Okay.
Omission.
Yes, I get you. It is one type of error. It's one type of error of omission when it is not included. So we are looking at the general or the standard profit and loss accounts. Okay. When we are treating errors, then we can consider the omission and see. Okay. Yeah. So we just want to take the standard profit and loss accounts. Okay, so after adding your income, you get you less operating expenses. You mentioned like 3 or 4 operating expenses, then we go to profits.
Electricity bills.
Okay. Utility bills. Okay.
Yeah.
Wages and salaries.
What again?
Rents and rates.
Wages and salary. What again?
Rent and
rent. What again?
Bad debt written off.
Yes, you've mentioned rent. Rent.
Telephone.
Bad debt and provision for bad debt. Telephone. Okay. Well,
Depreciation.
okay, so
Provision
then
for
you
depreciation.
get what after subtracting this depreciation, after subtracting the expense. Provision for depreciation does not
Fuel for
come
plants.
under profit and loss. Okay. Provision for depreciation does not come under profit and loss account. It also we only see it in the trial balance. Okay, so when you subtract all these expenses, what do you get?
You get your net profit.
You get your net profit. Did you see any specific information, or all that you are seeing is general information? Someone is into agric. Can the person adopt this statement or not? The profit and loss account, can the person use it or not? If someone is into like Unilever, into selling of items, can the person use that or not? If someone is into telecommunication, can the person use that or not?
Cannot use it because it is general purpose.
Why can the person use it?
They can use it.
It can be
It's
used,
general.
just that the items need to be stated according to maybe the company's dealings.
So if you pick Unilever financial statement, the first thing you see sales or revenue. Are you not going to see sales and revenue there?
You will.
You are.
Yeah.
If you pick MTN Ghana, MTN financial statement, are you not going to see sales or revenue there?
Yes, we are
You
going
You
will
are.
see it.
You see.
Yeah.
Won't you see inventory, either closing or opening? Won't you see?
You will.
Won't you see purchases?
You will.
And then if you come, won't you see gross profits? Won't you see expenses? Won't you see depreciation? Won't you see wages and salary?
You
Okay.
see all of them.
So why do you think that when they are in different industries, you cannot consolidate them? Why do you think so?
They can be
So it
consolidated.
is not possible. It's not. Yes. So whichever industry they are, they can be what? Consolidated. That is what we call standard. Standard. Okay. International's what? Standard. Or international accounting standard. Standard. Standard is standard. Okay. So whichever industry you find yourself, you must fit into that standard. So with the consolidation, whether you are okay using any of these methods, or if you are in any of the industry, you must be able to what? Consolidate each other. Now what you need to do is that you need to ensure that you use uniform accounting policies. Okay, uniform accounting policies. Okay, so that is all that you need to do. So if you are using for instance depreciation, you want to use straight line method because of what the parent institution is using, or you want to use reducing balance method. Okay, so you use similar accounting policies, then you ensure that it is consolidated. It doesn't matter. It doesn't matter. Okay. Now, what about the reporting dates? In Ghana, what is the accounting year for companies in Ghana?
From 1st
When
January
does
to
it
31st
end?
December. 31st December
So
every year.
1st January to the 1st December. Good. But if you have the parent having 1st January to 31st December and the subsidiary having 1st March or 1st April to 31st March, you see the accounting year, they are not aligned. Are they?
No.
They are not.
So can you consolidate them or not? And what do you have to do before you consolidate?
You can by apportioning
Can you
the
consolidate?
time period.
Good. So how will you do the apportionment? Do it in your mind and let's see. Hey, Daniel, where are you? What you are thinking?
Okay, Doc, please the question again.
Minta, was it not Minta? So I was asking whether you
It is
can
offline.
consolidate. Okay, consolidate companies, parent and subsidiary who has different accounting years, and you said we can consolidate. And I say how? I say by apportioning the accounting dates, the years. So I was asking him to give us an example and then apportion it for us. But it's off. So if you can do that.
Okay, so the little understanding I have here is that so if the we operate from 1st January to 31st December, then if the other statement has say March, we have to infuse it within the accounting year of the parent company.
Okay. Yeah, so that's fine. So you pick, if you are going by, you need to go by the parent company's accounting year. So you would have 1st January to the 1st December. So you need to pick if it is 2025 or let's say 2024. So we pick the parents 1st January 2024 to 31st December 2024. Then the subsidiary will be, the subsidiary account year will be 1st April 2024 to 31st March 2025. Then you must pick only 9 months of 2020, 9 months from 1st January, 1st April 2024 to 31st December 2024, 9 months. Then you go backward and pick the previous year, 3 years accounting year that entered 2024. So 1st January 2024 to 31st March 2024, do the adjustment using what we call pro rata. So the 3 months, you do 3 over 12 times the revenue for that 2023-2024 accounting period and get only 3 months and add it to the 9 months of 2024. If done, I readjusted the figures to get the complete 2024 accounting year, then you will add it to the per before accounting year. Do you understand? Or you want an example?
Okay. Please, there was some hitches in your We couldn't hear some of the
You
places
said?
well. There was some hitches in the audio. We couldn't hear some of the terms well. Can you please hint on it again?
So let's use this as an example. So the parent's account year ends 31st December of every year, right? No, 31st March of every year. That is the subsidiary's accounting year. But the parents own end 31st December of every year. So let's maintain the parent, no problem. Then the subsidiary will be what we are going to look at. So the subsidiary
Hello.
Hello.
It seems he might be. Let's
Oh,
wait. Let's wait a little for him.
okay. Africa.
Yeah,
Hello.
I think he's totally offline.
So maybe Africa has his number two. Africa, please come in for answer. Maybe he's not aware.
Okay.
okay. Someone. I hope now you can hear me.
Yes,
Yes, please.
Can you hear me now?
hello, yes,
Yeah,
sir.
I can hear you.
Okay. So I'm saying that simple language, pick the portion that enters into the accounting year of the parent. Okay. And do the calculations and put it there. So if the parent subsidiary is, let's say, 31st, no, 1st April 2023 to 31st, three is for okay. That's
Hello.
Please, we can hear.
Okay, same here.
of of there
Hello. Hello, Sister Rita.
Yes,
Hello.
yes,
yeah
Please
yes.
inform me that his line is breaking. We can't hear him.
Okay,
is you can hear
No, please, we can't hear you, Doc.
No, please.
please, I have informed him.
All right, thank you.
Okay, thank you.
You can hear me now, right?
Sure.
Yes, please.
Yeah, so it means we can even swap the classes. You see, we can bring management accounting to Saturday, then advanced accounting on Sunday morning. What do you think?
All right, Doc.
Yeah, so next week, remind me so that we do that. So that the calculation for advanced accounting, we can do it in the morning and then think it will be better off. Let's continue. Okay, so we've talked about NCI. I sent you the format. Please, have you seen the format?
Yes, please, I've shared it.
Okay.
It's
I
on the
hope
platform.
everyone is having the format.
So,
Is everyone having the format?
yes, Doc.
Yes, Doc.
Hmm.
Yeah.
Okay.
Please, I have it.
All right. So have a look at the format. I'll take you through soon. Um,
Hello.
yes, sir.
Please, Doc, because of the voice breaking, we couldn't get the explanation of the time periods between the parent and the subsidiary when it gives it.
Oh, okay. I said that when the parent's date is different from the subsidiary date, you would have to do the adjustment and then do the calculations, then readjust the subsidiary so that it will be in line with the parent. So I gave an example that, okay, so everybody should write this down. The date is very important. So the subsidiary is the parent is 31st December every year. So 1st January to 31st December, no problem. But the subsidiary is 31st March of every year. So the subsidiary accounting year is 1st April, okay, to 31st March of the following year. So I want to give an example, then we do the calculation, right? So if the subsidiary accounting year is 1st April 2023 to 31st December, 31st March 2024, the revenue is 80,000, no, 60,000. That is 60 or 80,000. Okay, is what? 60,000. Let's use 60,000. Please, have you gotten it? So the 1st April 2023 to 31st March 2024, the revenue is 60,000. Right? Please, have you gotten it?
Yes, please.
Okay, Doc.
Then we have 1st April 2024 to 31st March 2025. The subsidiary revenue is 80,000. I hope you have gotten that one too.
Yes, Doc.
But the parent is 1st January 2024 to 31st December 2024. The parent revenue is 100,000. You cannot add the two together because the revenue for the subsidiary is not one year as the parent's accounting year is. Part of it is in 2023, part of it is in 2024, part of it is in 2025. So you need to do the calculation and do the adjustment and get the revenue that belongs to only 2024. Right? Now let's pick the first revenue for the subsidiary. How many months of that revenue belongs to 2024? Hmm?
3.
3. So 3 out of how many months?
12.
12.
How much is the revenue for that period?
60,000.
So the 3 months revenue, if you do proportion, you get how much?
$15,000.
You get 15,000.
15,000.
15,000, right?
Yeah.
So the 15,000 belongs to January, February, and March of 2024. Then the second revenue, how many months of the second revenue belongs to 2024?
9.
9. And that constitutes what amount of the revenue?
$60,000.
60,000. So the whole year revenue for 2024 for the subsidiary will be how much?
$75,000.
Okay, so that is what you do. So what will be the consolidated revenue for the two companies? How much?
175,000.
Yes, so that's what I was talking about. Plenty. Mhm. I hope no one is confused. Or if you are confused, let's know.
Please, you said the remaining number of months is 5. I don't get it for the 2024.
I said 9. 9 months.
9. Please, from where to where?
We have 12 months, right? And the first one we had 3. So just take the 3 out of the 12. You get 9 months.
Oh, okay. I get it.
Okay. So that is it. I hope no more issues. Now, the consolidation format is interesting and is the foundation of this that we have consolidated income statement of consolidated. You all know balance sheets, right? Or you don't all know balance sheets? Or the network, you can't hear
Please,
me.
we do.
Okay. So what we do is that we just add the assets of the parent to the subsidiaries assets, the non-current assets. We add the current assets, but we don't add the equity. You don't add equity together. Okay. We add non-current liabilities together. Then we add current liabilities together. So if you pick the parent non-current asset, PPE, so you add PPE of the parent plus the PPE of the subsidiary. Now you check if there is any PPE or any assets that was not properly fair valued. You do the fair valuation, it will be given to you in a question, and you bring it here. You come and add it to it. If it is brand, and maybe the brand too was also omitted, intangible assets, it was also admitted. When you do the calculation, you come and add it together. Then since the assets was what? Omitted for the whole year, and you've gotten it, then there will be depreciation associated to that asset. So in the question, they will give you, if there is depreciation, they will give it to you. Okay, so that is it. So you add all of them together. Then you have the receivables of the parent plus the receivables of the subsidiary. Then you have inventories of the parent plus the inventory of the subsidiary. Now, sometimes the parent can sell goods to the subsidiary, or the subsidiary can also sell goods to the parent. I mean, they are into business. But at the end of the accounting year, if the goods are left and not sold, then it raises a concern about unrealized profits. If the parent says to the subsidiary, the parent controls 60% of the subsidiary, and you are selling it to them again, the profit the subsidiary will make, you go and take 60%. So why are you selling goods to them? Just consider them as a branch. So, but if the subsidiary is able to sell the goods before the year ends, we will not have unrealized profit. But if the subsidiary is not able to sell the goods, then the year ends, some of the inventory is still in the stock, then it creates unrealized profits. So we have to do that calculation, then we get that. Sometimes too, one subsidiary or one company can send goods to another company, but the goods will still be in transit before the accounting year ends. For instance, if the parent is in Accra, subsidiary is in Tamale, the parent send goods to Tamale on 30th December. Then the goods have not been able to get to the stores of Tamale on 31st December, by the end of 31st December. 31st, the Tamale accountant will not record any goods. Will the accountant record any goods? Please, can you hear me?
No.
Yes. So the accountant will not record any goods, terminal accountant, because he has not received any goods. What about the Accra accountant? Will that
They will.
good?
You will.
They would. So if you are balancing the figures, do you think it will balance off?
No.
No.
Good. So the goods haven't gotten to terminal accountant. So the goods are in what? Transits. Then with the cash too, we add parent cash to subsidiary cash. Then it's also possible that maybe there is an amount that one accountant has to go and pay into the other company's account. The accountant has prepared all the PVs. Everything is set. They've signed, the check is signed. He has sent to the bank. The bank has received it on 31st December and has made payments. Stamp on it that has been paid into, let's say, Accra accountant has made payment to terminal accountant, or terminal accountant has made payment to Accra accountant on a certain transaction. But the bank was too busy that they couldn't effect the actual payment. Either they have effected and it did not reflect in the books of Accra accountant, or they haven't effected the cash, the payment, and 31st December midnight reach. So terminal accountant will say, okay, Accra people are owing us, but Accra accountant will say what? We have made a payment. So money is hanging somewhere. Is that not the case? So in that case, it also creates what we call goods in transit. Sorry, cash in what? Transit. Cash in transit. Is that okay?
Yes, Doc.
Yeah, Rita.
Please, Doc, why is it that the goods in transit we less, but when it comes to cash in transit we are adding?
It's a good observation. So it is either less or add. Okay.
Okay.
It's either less or cash. Add. It's a good observation. So if let's say one of them is claiming that you are owing. If you are owing the other one, it means you are supposed to do something you have not done. So if it is inventory materials you are supposed to send to them, you haven't sent it, they'll say you are owing. So when you sent the material, that amount must be cancelled off. Okay? It must be cancelled off. Then if there is no transaction, so that is where the minus will come. So if there is no transaction amount due, but it is a created account transaction, you have sent the goods and the goods haven't reached them, they will not keep anything, any records of the goods. Then you have created an account that they are supposed to pay you. So in that case, if it is discovered that the goods were actually sent, you have created it, they too must also create it. So that is where you add the goods to the inventories. So the same thing for cash. Okay. So it depends on the transaction. So either add or you subtract. Okay. So the next is stated capital. We use only the parent stated capital. Capital surplus. We use only the parent capital surplus. But the retained earnings or group retained earning, we have to do workings. You see that I've jumped goodwill here. That is workings 3. So you need to do group workings 5 to get group retained earnings. Then the surplus, revaluation surplus, if there is any, is only the parent. So apart from the group retained earnings, you would do the calculations. The rest, those three guys here, you use only the parents to do the calculations. So be careful. Don't go and add the subsidiary to the parent. Then workings 4 will be NCI. So you go and do workings 4, NCI workings, and bring the figure here. You do workings 3 and bring the figure here. You do workings 4 and bring it here. Then workings 5 and bring the figure here. Then non-current liabilities. So we have deferred or contingent liabilities. This is coming from purchase consideration. We'll look at this very soon. We have 4 types of purchase consideration. When you acquire a subsidiary, you either pay cash, or if you like, you can defer the payment into the future. Then when you defer the payment into the future without any consideration, without any condition, then it becomes deferred consideration. But if you defer the payment into the future and then the deferment is conditional, that you must do something before we pay you. For instance, you should obey the environmental regulations, or you should improve on your profits, or you should comply with tax regulation. Then there is a condition attached. That is what we call contingent consideration. So the difference between contingent consideration and deferred consideration is that with a contingent, there is a condition attached you need to comply with. Then deferred is just that you can't pay now, you have deferred it into the future. Whichever it is, whether contingent or deferred consideration, the payment is in the future. So if the payment is in the future, it creates what we call time value of money issues. With the time value of money, the value of 1 CD today will not be the same. The value of 1 CD will not be the same in 1 year time. So therefore, there will be issues of discounting. There will be issues of discounting. So you need to do the discounting. Now, because you would, if you were going to pay it now, you wouldn't have incurred so much money as paying it in a year time. Is that not the case? If you are paying it now, you will not incur so much money as paying it in 1 year time. Now, if you pay it in 1 year time, you pay more. But if you pay it now, you pay less as compared to paying in 1 year time. Now, because you pay more in 1 year time, or in the future, you are getting what we call unwinding cost. Unwinding cost. So that is also a liability for you. So this unwinding cost, you would have to add it again to the deferred consideration or the contingent or deferred consideration. Then you get the total amount here. Now the unwinding cost will now go to workings 5, which is group retained earnings. Workings 5, group retained earnings. Then the calculation of this consideration, the consideration is in workings 3. Goodwill, calculation of goodwill is in workings 3. So we'll look at it into detail soon. If there is a loan or debenture, you add the parent loan to the subsidiary loan. Then if there is deferred tax, add the parent tax defer to the subsidiary. Then current liabilities too. For the payables, you add parent plus subsidiary. And then if there is any current tax, you add parent to the subsidiary. So that is what you do to get the consolidated financial position. Please, any question before we move to the workings? So these are the workings. So we have 5 standard workings We are going to look at it soon. Any question on this before we move to that? Any question? But I hope you can hear me.
Yes, no sense
Yes,
for now.
please.
I think
Okay.
no question.
Please, I want to find out why maybe let's say the parent company has a goodwill, and then the subsidiary too does, and because they have different names, can it be
So the
recorded?
the parent company, is it my network or his network? Are you asking why the parent
Yes.
company has goodwill and the subsidiary too has goodwill? Is that the question you're asking?
Yeah, I mean, do
Yes.
both of them have together, or it should be separated?
Yes, so the parent company does not have goodwill because you haven't purchased the parent company. Okay. It's the subsidiary that you purchase.
Okay.
So it is the subsidiary's goodwill calculation, but you are putting it in the consolidated. This is not a financial statement for the parent. This is the group financial statement, right? So that is where
Yes.
the goodwill is coming. So it's
Thank
only
you.
coming from the subsidiary. Now we have two types of goodwill. Okay. We have negative goodwill and positive goodwill. Now, the negative goodwill is also called bargaining power. The bargaining power. Now, let's look at this scenario. Let me use you. So, is it Neku or Naku? Daniel.
Place is Naku.
Naku. Naku,
Yes.
what phone are you using?
I'm using Samsung.
Samsung. Minta, are you here? Okay.
Yes, please.
So Minta, you are buying a Samsung phone from Naku. Naku, how much are you going to sell the Samsung phone?
Okay, I'll sell it at 5,000.
Minta, how much are you going to buy the Samsung phone?
4-5.
4-5. Now, Rita, you are the market expert. So we assume you have assessed Naku's Samsung phone. Naku is selling it at 5,000. Minta is buying it at 4-5. So Rita, after assessing the phone, forget about the prices that they are buying or selling. After assessing the phone, how much do you think the phone is?
I don't get the question.
So Naku, so let's assume that Naku, the 5,000, okay, that is the book value, okay, or the carrying amount, okay, Naku, in your books, that is the carrying amount of the phone. Minta is offering 4,005. Then I'm asking you, as a market expert, how much are you going to price? What is the market price of Naku's phone? I'm asking you to give us what is the market price of Naku's phone.
The 5,000.
No, don't choose the same figure. It can be above or below. Just choose any figure.
Okay, 4,000.
Oh no, you are going to kill us. Okay, so let's do.
Sir,
Yes.
if I'm the marketer, a good marketing expert, I will price it at 4,800.
You don't know that, you don't know the market, you don't know the carrying amount of it to be 5,000. You don't also know that Minta is offering 4,500.
Okay,
Just look
okay,
at
okay.
the value of the phone and tell us how much it is. Don't consider the fees.
Okay, then approximately it will be 4,700.
Okay. Now, okay. Minta is very skillful in buying things. Okay. So Minta is able to buy the phone from NACO 4,500. NACO has no option. Minta has able to buy NACO 4,500. The thing should have been 4,700. But Minta has been able to buy it 4,000 what? 5. Do you get a point?
Yeah.
Okay, dog.
So Minta's amount is the purchase price or purchase consideration. Then Naku's amount of 4,007, okay, would have been how much? That is the carrying amount of the
The
that
phone.
is carrying amount of the phone, right? Then
Yeah.
Minta bought it 4,500. When Minta is going, he is jubilating in his mind that he has been able to bargain. Okay? Is that not it?
Yeah.
He has been
Yes.
able to
Yes.
bargain and
Yes.
he
Yes.
has won. So the calculation is purchase consideration minus carrying amount. So with the Minta's amount, are we going to get negative goodwill or positive goodwill? If the formula is purchase consideration minus carrying amount to give us positive goodwill.
Okay. Let's see.
How much are we getting? We know it's 200, but is it negative or positive?
Negative
It's
200.
negative.
Good, negative.
Yeah, negative.
That is negative goodwill. So with a negative goodwill, Minta will not go and add the 200 as an asset to. Minta will go and add the 200 as a gain.
Negative.
You get a point? Minta will go
Yeah.
and add the 200 as a gain. Now look at the other way. Rita, let's put your figure as 5,000. But when Daniel knows, okay, and Rita too knows that the value of the phone should be 4,007, or the carrying amount, what is in the books of NACO is 4,007. But NACO and Rita, after their negotiation, they bought it, Rita bought it 5,000. Are you going to say Rita has made a loss in buying the phone? So we will look at it. If Rita buys it 5,002, is it going to be negative goodwill or positive goodwill? And how much? So Rita's amount is now the purchase consideration.
Okay.
Okay, to the company, to me selling, I'm going to make a positive goodwill.
Yes, so you are making a positive goodwill of how much?
300
Of
CD.
200 CDs.
So now when you bring the phone, how much will you value the phone in your books? Forget about how much you bought it. How much will you, forget about everything, and then you brought the phone. How much will you value it in your books? Are you going to value 4,007 or 5,002?
5,000.
5,002, right?
Yes, sir.
Yes.
Good. So that is what is the difference of how much? 5,500, 4,007 to 5,002 is how much?
500.
Yeah, 500.
Yes, so that 500 is what we call goodwill. So it means that we have a phone which has a carrying amount of 4,007 at 5,002. The phone can do is unbelievable, more than the 4,700 amount. So Rita believes that it's very good. Therefore, increasing your value from the value you know already is what you call goodwill. Are you on point?
Yes,
And
sir.
that is positive good. That is positive goodwill. So the accounting treatment for positive goodwill is to add it to the assets, okay? Non-current assets in the balance sheet, okay? Then the accounting treatment of negative goodwill is to add it to your gains. Add it to your gains, because negative goodwill give rise to bargaining or gains, okay? Even though the name is negative, but it tells you that you have gained from it. But the positive one tells you that the asset you bought, you must increase that value of by the difference that gives you a positive goodwill. We would look at that. All right, so let's look at the standard question. If you have any other question, you can ask. Now the formats, okay, the calculations, I said 5 standard workings. 5 standard workings. Who can give us any standard any workings he knows? Because I've mentioned almost all of them. Yes, so just mention any workings you think we should do. Who remembers any workings? I've mentioned all of them here.
So we have
Or you can't hear me.
structure. We have the control structure.
You said
we have
control structure.
And then
Okay, control net assets of the subsidiary.
And then we have the cost of investment or control.
What's the other name for that?
Goodwill.
Goodwill. Which one again?
And then we have the non-current investors.
Non-current NCI. Good.
Yes.
NCI. And then finally?
And then we We have the group retained earnings.
Group retained earnings. Group retains earnings. Now, so the first one is control structure. You want to know how much belongs to the group, right? And how much belongs to what? NCI. So now I'll give you a question. Please, everybody should participate. If company A acquires company B by 25%, please calculate the group and then NCI. Fast. What will be the group percentage? What will be the NCI percentage? Abukare.
Say.
Yes. What is the group and what is the NCI?
The NCI is 25.
The group is what?
The group is 75.
If company A acquires company B by 54%, by 54%. So what is the group and what is the NCI? Delali. What is the group and what is the NCI? Minta?
Please, the group is 54% and the NCI is 46%.
Okay. Now moving to different scenarios. If company A acquires company B, I'm taking it again. If company A acquires 6,000 shares of company B, and company B has 8,000 shares, what is the group and what is the NCI percentage? Shall I give again?
Yes, please.
If company A acquires company B, company A acquires 6,000 shares of company A's 8,000 shares, what is the group percentage and what is the NCI percentage? Who's ready? Who is ready?
Let me try.
Okay, try.
The group is 75%, and therefore NCI will be 25%.
That's good. I'll give you another one. If company A acquires 260 shares, 260,000 shares of company B's 300,000 shares on 1st January 2022, and the reporting date is 31st December 2022. What is the group percentage and what is the NCI and what is the acquisition date and what is the reporting date? And is it a full year or how many months? Yes, Daniel.
Please come again with your question.
If company A acquires 240,000 shares of Company B on 1st January 2022. And the reporting date is 31st December 2022. What is the group percentage? What is the NCI? What is the acquisition date? What is the reporting date? And what is it full year or half year or how many months? Naku, is your hand still up? Or is an old hand? Okay, Abukare.
The year is full year
Okay,
because from January to December, so it's full year.
okay.
So now it align with the NACO and the rest. So I'm doing the working.
Okay. Yes, yes, please, fast. Oh, you don't need to do working. Just pick your phone and punch. 2 punches, you get the answers for everything. Who is ready?
I'm lost with the figures.
The group.
Okay, Minta.
I had 80%. 80%.
Okay.
And therefore the NCI will be 20%.
Okay. What is the acquisition date and what's the reporting date?
1st January 2022 is the acquisition date. And the reporting date should be 31st December 2022.
Okay. Last one. Company A acquires 9,500 shares of Company B's 15,000 shares. I hope you are following me.
Yes, sir.
By the time, this one should be like maths and science. So by the time I finish the question, your answer is ready. Right? So by the time I finish the question, your answer is ready. Company A acquires 9,500 shares of Company B's 15,000 shares on 31st March 2024. The accounting year of the two companies is 31st December of every year. What is the group percentage, the STI percentage, and what is the acquisition date and reporting date if the financial statements are prepared in 2024, and how many months or year or what? Who is ready? Who is ready? I hope you got the question right.
Please, can you come again with the question? I'm a bit confused.
Hello, Doc.
I think it's offline.
Who was able to get the latter part of the question? About the time period, Hello, Rita.
Yes.
Were you able to get the latter part of the question?
No, let me read if that's all you are
Okay.
looking for. Said the accounting year of the two companies is 31st December every year.
Okay.
Yes, who is ready? Who is ready? Who is ready? Mm-hmm.
The reporting date is 31st December 2024.
Mm-hmm.
And the group, I had 63, and the NC I had for 37%.
Yeah.
Acquisition date. What's the acquisition date?
31st March 2024.
So what's the period? What's the period?
9
How many
months.
months? 9 months. Okay. That's good. So we are done with this. Any question you see on control structure, I believe you will be able to answer, right? Okay. So let's look at the next one, net assets of the subsidiary. I said net assets of what?
Subsidiary.
Did you see parents here?
Subsidiary.
No.
Did I say net assets of parents?
No.
No, Doc.
So never go and use parents' figures for any of this. Any of this. I don't want to see any parent figure there. So we have at acquisition date, right? In your mind, you know the acquisition date, right? What is the acquisition date? Just change the English. That's all. What's the acquisition date? Hmm? The date you acquired the shares. That's all. What's the reporting date?
The day it was prepared.
Yes. So you see that the date it was acquired is not the same date it was prepared, right? The
Yes,
example
Doc.
we just give. Now, the difference between the date it was acquired and the date it is prepared give rise to what we call post-acquisition what? Profits. Or you can simply call it difference. Now, the stated capital is the same stated capital at the date of acquisition and in the same stated capital at the date of what? Reporting. So do you have any difference? Or what is the profit after? That's fine. Is there anything?
No change.
No change. Now look at the retained profit, the retained earnings, also known as the profits. The profit at the date of acquisition is the beginning profit. It will be given to you in the question. The profit at the closing date is at the reporting date is the closing profit. Okay. So you see that the profit will not be the same from the acquisition date to the what? Reporting date. The difference will give rise to what?
Profit or loss.
Profit or loss. Now the assets that have been fair valued, maybe we forgot on the asset at the date of acquisition. At the date of acquisition, some asset was forgotten, and therefore we realized that this asset was to be there. So we need to fair value those assets. So at the date of acquisition, the same amount to be fair valued, and then at the date of reporting, the same amount, and therefore the difference is what? 0. However, so the assets that can, those assets can be PPE or inventory. However, these same assets, they can depreciate. None of the activity. So if the assets depreciate, they will look for the depreciation policy, whether it's in the useful life or percentage. Then that same value that you have seen at the acquisition date, there is no depreciation because that is the beginning of the year, no depreciation. Then at the reporting date, it has gone through the whole year and you need to get depreciation. So you see that at the acquisition, there is no depreciation, and at reporting, there is depreciation. And therefore, the difference will come here as depreciation. Then brand is treated the same way as assets. So brand at the beginning of the year, the same, acquisition did the same, reporting did the same. And then there is difference of 0. The brand can also depreciate. When a brand depreciates, which is intangible, okay, when intangible depreciates, what do we call it?
Amortization.
Good. So amortization. So the brand can depreciate and we get amortization, the same treatment. At the beginning of the year, there is no amortization. At the end of the year, there is amortization, and the difference will go to profit and loss account. Now, sometimes too, we can also have capital surplus or revaluation surplus in the question. You saw it in the formats. So if you see it for the subsidiary, you bring it, treat it the same as capital. So at the acquisition, the same amount, and then at reporting the same amount. So the difference is 0. The difference is 0. Right. Then you will now find the surplus. You will look for the surplus. You look for the surplus, which it does, you look for the differences, no surplus. So you look for the total, you add them together. So this one becomes the total. So it will now be like the difference between acquisition and reporting should give you the same figure here. This workings 2 is the mother workings, mother of all the workings. If you do the workings 2 well and you get everything right, I'm telling you, consolidation, you are going to score 80%. So master it. Any question on workings 2 before we go to workings 3? If you don't get something, let me know. Any question? Or we should continue.
Yes, sir.
Yes, please. Let us continue.
All right. Now workings 3, which is goodwill. Okay. We start with purchase consideration. The purchase consideration, we have 4 types of purchase consideration. When you acquired shares, when you buy something, you have the option of paying using these 3 methods. You can pay through cash, which is immediate. So the cash amount is here. You can also decide to pay it in the future without any condition. So if you are paying in the future without any condition, it is here. So you do discounting, you discount it. Then you can also pay it in the future with condition, that is contingent consideration. Then you can also decide that, okay, you have shares, I have shares. Why don't we do share exchange? we can exchange the shares among ourselves. Then I'll say, okay, I'll give you any 3 of your shares, you get 2. So you see 2:3, and then you see 5:7, you see 3:2, you see 1:2, or you see 2:1. Okay, that is share exchange. Then with that one, when you see like that, the one that comes first should be numerator, then the one that comes last should be the numerator. Then you multiply by the number of shares that are available. Okay, then you would multiply by share price. So let me give an example. So if it is you acquire the shares, but you do it through share exchange, and it's 2:3, and the number of shares acquired is 30,000. Okay, and the share price is 50 pesos. So what you do is that, if you don't follow me, I'll come and give you questions. So I'll take the question again. The share exchange is 2:3. The number of shares that is in the subsidiaries account is 30,000 shares, and the share price is 50 pesos. So what you do is that the one that comes first, 2/3 times 30,000 times 0.5. So what I do?
Hello. Please, your line was breaking.
Yes.
Yes, please. After giving the question and the explanation, we couldn't hear you.
Did you hear the question I was trying to? Or
Yes, please. Yes.
Yeah, it's better
so
now.
I said the question is, okay, the question is that you are having shares of 2. The share exchange of 2 for 3. Right? And the number of shares is 2/3 times.
Yes, yes, it's clear now.
Right? So how much are you going to get?
20,000.
'Are you sure?
It should be 10,000.
2/3.
The shares will be
So 20 or 10?
10. The shares will be 20,000 shares. You multiply by 50 pesos, which is half of 1 CD. So it's going to be 10,000.
All right. So 10,000 shares. So let me give another question. So if you acquired, A acquires B, but the agreement is that they would do the settlement, okay, through share exchange with 3 for 4 shares. 3 for 4 shares. And then the subsidiary has 60,000 shares, and the share price is 150 pesos. What would be the purchase consideration?
Please, the share price is how many?
150 pesos.
That's 56,250.
52,000. Okay. Has anyone confirmed that? So it is 4 for 3 or 3 for 4.
3 for 4.
So 3 over 4 times how many shares?
60,000.
Then is the share price is 1 CD what?
50 peso.
And you say you have gotten how much?
67,500.
Hey.
No, I had 67,500.
Okay, 67,500. So that is all for share exchange. Okay, so you just come and put it here. Now let's do these guys, deferred consideration and contingent consideration. I said that both of them are in the future, right? And if they are in the future and you want them now in finance, what do you do?
Consider time value of money.
Okay, so what formats or what method are you going to use to consider time value of money?
Present value of a future sum.
Okay, so we discount it, right? All right. Now A acquires B. Okay. At A acquires B and paid cash of. So let me put the whole question. A acquires 60,000 shares of B's 80,000 equity or stated capital on 1st January 2023, right? On 1st January 2023. A pays so let me see. Thank you. If I give that, it will give you plenty information. I think you should have the question with yourself. So let me just use that. So consider the date. The date is 1st January 2023. Then it agreed to pay 30,000 on 31st December 2024. Okay. 31st December 2024. Cost of capital is 10%. So what will be the cost of capital is 10%, right? So the first question is it contingent consideration or deferred consideration? That's the first question. Is it contingent consideration or deferred consideration? Please, did you get the question?
Deferred,
Deferred.
Why?
because it's higher to pay later.
Is that the reason?
Please, you say with a deferred, there's condition attached. So I don't think this one there's condition attached. So with the contingent, there's condition attached. So I think this will be deferred.
So that's the right answer. So it deferred because there is no what? Condition. All right, so calculate the deferred consideration and then calculate the unwinding cost. Or I should do the deferred first before the unwinding cost. So it was acquired on 1st January 2023 and the amount that is supposed to be paid on 31st December 2024 is, why don't I give you 31st December 2023? Okay, let me start from 1 year. So 31st December 2023 is 30,000. And the cost of capital is 10%. So how much is the fair consideration? Yes, how much?
It's 3,000.
No.
Okay.
$33.
Huh? Yes, how much?
2,700.
Good. 2007. Is it 2000 or 27,000? It's 30,000.
Yeah, sorry, 27,000.
Yes. So how did you get the 27,000? Explain it quick for us.
I took 10% of 30,000, and I had 3,000. That was what I said first, and you said no. So then I subtracted it from the 30,000. So that gives me 27,000.
Then Abukari, your answer is coincidence.
No, like I was smart of what I'm doing. I'm smart of what I'm doing.
Yeah, but still you are smart, but it's through coincidence. That is not how it's calculated. Who help us? You are doing discounting. No. You are doing compound interest. Have you forgotten of your discounting factor? So we have to do the discounting factor first and multiply it. So if it is 10% and you're doing discounting factor, what's the formula for discounting factor? Is it not 1 over 1 plus k raised to the power n, right? Do you remember? 1 over 1 plus k raised to the power n. Do you remember that? The compound interest, simple
No,
interest, simple interest. Wow. Okay, so that is it. So you can go and look at the compound interest formula. So we have 1 over 1 plus k raised to the power n, or 1 over 1 plus r. You can use r raised to the power n. So let's find the discounting factor first. So if the rate is 10% and the n is 1 year, is that not 1 year from from 1st to 31st December? Is 1 year, right? So what are you going to get? So you have 1 plus 0.1. 10% is 0.1. Is that not the case?
Yeah. Yes.
So 1 plus 0.1, it will give you what? Is it 1.1?
Yes. It's 1.1.
Okay. So 1.1, right?
Yes.
1.1 is what? Mm-hmm.
That is
0.9.
0.90909.
909. Three decimal places.
Okay. So multiply that by 30.
Okay, that's 27,272.7272.
Okay. So we are going to get 227,272, right? So that is it. So that will be your deferred consideration. Then the unwinding cost will be the difference. The difference between 30,000 and then 27,272. What is the difference?
2,727.27.
Good. So that is unwinding what? Cost. The same thing for contingents. It's just that the difference is that one has a condition, one does not have a condition. Calculation is the same thing. So this unwinding cost of 2,720 will go to workings 5 group retains earnings. So that is how you do to get this one. So don't worry, we will be solving them next week. We are still going to do consolidation. We are still going to do consolidation next week. So don't worry, we'll still be solving that. But after this, I'm giving you the notes. You go and solve the questions there. Then next week, when we meet, we continue. Is that okay?
Yes, sir.
Good. Because consolidation will come on. Consolidation will carry almost close to 50% of your marks. Right? Okay, so
Yes,
that
sir.
is it. Now, so purchase consideration, you'll see these 4 items, but it's not all the time you see all the 4. You may see just 2, just cash and deferred, or just cash and contingent, or you see 3, share exchange, deferred, and cash. You will not see all of them. Then we have fair value of NCI. So you check, the NCI has 2 methods, proportionate base and then fair value base. So if it is fair value, you see the NCI is here. But if it is proportionate, NCI will not come here. Now, the next thing is to less net assets taken over. This is very easy, right? This is very, very easy. Net assets taken over. You see, stated capital, retained earnings at the beginning, fair values of assets, brand, and the surplus. It's coming from workings 2, right? And that is here. This guy. Have you seen that? The first is stated capital, retained earnings at the beginning, fair value of assets. Then you see depreciation is not part. Brand is there. Amortization is not part. Then capital surplus is there. So you look at it here. Stated capital, retained earnings at the beginning, fair value of assets, brand, and then capital surplus. Have you seen the trick?
Yes.
So if you do your workings 2 very well, you are scoring workings 3 direct. You are scoring it. If you are able to do the purchase consideration calculation well, you are going to score, because you just go and copy workings 2 and come and put it in workings 3. Then when you do that, you get this total. So this figure should be the same as this figure. Okay? So the same figure. You subtract it from this figure. You subtract this figure from this figure, then you get this figure, right? The question will tell you whether there is impairment loss or there is no impairment loss. Sometimes they'll give you a figure, or sometimes they'll give you a percentage. You say 25% of the gross goodwill is impaired, or 25% of the goodwill is what? Impaired. So you just calculate 25% of the answer you will get here, and then you subtract it from it, and you get net goodwill. You get net goodwill. Okay?
Okay.
Now, this net goodwill is going back to the balance sheet. Do you remember? This goodwill is going back to where? Balance sheet. Let's go and see where we can find it in the balance sheet. Where can we find it in the balance sheet?
At the top there.
Good. So it's here. So if you don't do that workings well, you cannot get this answer. So as soon as you do the workings, you bring the answer and come and write it here. But yes. So this is coming from workings 3. Workings 3. Then the next is NCI. I said NCI has 2 methods: proportionate base method and then fair value method. Don't forget to. Okay. I said NCI has how many methods and what are they?
2 methods: proportionate method and a fair value method.
Good. And when it is which, so that when it is fair value method, what will you do in the work, in the goodwill calculation? Okay, so when it is fair value, you just, after getting your purchase consideration, you bring the fair value amount here, right? Add it to the purchase consideration before you get this total figure. But if it is proportionate base, you don't do that. Okay, so let's still continue. So if it is fair value method, you do that. Then this figure, you don't do percentage. You don't take any percentage of it. You just take the whole amount. But if it is fair value, you don't bring the fair, sorry, if it is proportionate, so you won't have fair value. So you don't bring the fair value amount here. Then the total for these guys, the total for this, you look at the control structure. If it is 60% against 40%, you will come and multiply that total here by 60% and bring the figure, the answer here. If it is 80%, you multiply by 80% and bring the answer here. Before you subtract it from this to get your gross goodwill, then you take your impairment, then you get the net goodwill. So if NCI is at fair value is, sorry, the goodwill, sorry, the NCI is at fair value. Okay, in the calculation of goodwill, you just bring the fair value amount after consideration, and you don't take percentage, okay, of the total assets you have. But if the NCI is at proportionate, you would have to just, so that's where more calculation is required. So you would take the percentage that belongs of the assets that belong to the group, and then take it from the purchase consideration. Then you will take the impairment loss, then you get the net goodwill. So 2 methods will determine how workings 4 is done. So let's start with NCI as a fair value. So when NCI is at fair value, our focus is on this guy. So when NCI is at fair value, the whole fair value amount, we'll just bring it here. We'll bring the whole fair value amount. That's when NCI is at fair value. Okay. Then you share the profit that is you have made. So if it is 80%, NCI is 20%. So you take that profit here. Now, this is very simple. It's coming from workings 2. So in workings 2, we said that there is this profit we are making. So you just take the percentage. If it's 80% of this amount that goes to group, and the 20% of that go to NCI. So that is from here, for here. Then the impairment loss that you have calculated, if NCI is at fair value, okay, if NCI is at fair value, the impairment loss will be shared, the loss that you have made will be shared between NCI and the group. Okay, so let's go back to the profit. So this profit you have gotten in workings 2, this profit, you will share it between the group and NCI. So if the percentage is, group is 80, NCI is 20, you come here, you give 20 to NCI here, okay? Then you give 80 to the group, workings 5. Then if there is impairment loss that you have calculated in workings 3, you will come and it's at fair, NCI is at fair value. Right now we are talking about fair value of NCI. So you come and give the NCI portion of it, so 20% of the impairment loss. Then the rest of the impairment loss, okay, will go to the group, okay? So 80% of the impairment loss will go to the group, right? Then if there is a realized profit, okay, if the parent sells the subsidiary, okay, before I go to a realized profit, let me still talk about the 2 methods of NCI. So I'm summarizing the NCI at fair value. So if NCI is at fair value, okay, the first treatment is that you bring that NCI figure here. Then that fair value of NCI you brought in workings 3, you come and bring it in workings 4, fair value of NCI here. Then you will check impairment loss. Has it been impaired or not? If you have impairment loss here, you share the impairment loss between the group and the NCI. So NCI, for instance, is 20%, and the group is 80%. That is when NCI is at fair value. When NCI is at proportionate, this will not come at all. So you don't bring this here. You get the total purchase consideration, you put it here. But the total for the assets will not be the 100%. You must take the percentage that belongs to the group. So if it is 80-20, this total, you come and multiply the total by 20% and put it here, okay? Then you subtract it from the purchase consideration, and then you get impairment loss. So the impairment loss will be here. So if NCI is at proportionate basis, the impairment loss will not have to come. So with that one, with the NCI here, you won't bring it. It won't come. Then when you come to the NCI itself, that percentage you have done the calculation, okay, that percentage will come here, not the fair value, the portion of the net assets taken over. This NATO means net assets taken over, okay? So this is the figure is taken over. So this one. Are you people there?
Yes, sir.
We are here.
We are here. We are enjoying the class.
Okay. So that is it. Then with that one, with the NCI at proportionate base, there wouldn't be any fair value here. This will not come. And the 2 methods cannot come in the same question. That's what you need to know. One question, one method. So the 2 methods will not come in the same question. All right. Then that is it. So the last thing you will talk about in workings 4 is to look at the, you have two companies, parent and subsidiary. Definitely they are ordinary companies, so they can sell to each other, right? Parent can sell to subsidiary, subsidiary can sell to parent. That is not in doubt. But we are saying that consolidation rules say that if one company sells to another company, and at the end of the accounting year, which is let's say 31st December, and the goods are still in the stock of the company that is supposed to sell to the third party, that goods, that stock of goods have some element of profit on it, which must be eliminated. Hence, we call that element of profit as provision for unrealized profit. This PEP, provision for unrealized profit. Now, let's do this practical analysis. Parent can sell to subsidiary, right? Subsidiary too can sell to the parent, true or false?
True.
If the parent sells to the subsidiary, who enjoys the profits? The parent sells to the subsidiary and adds some element of profit to it. Who enjoys the profits?
Parent.
If the subsidiary sells to the parent and adds some element of, who enjoys the profits?
Subsidiary.
Subsidiary. Please, are you getting confused?
Please, is it not both? Why only subsidiary?
So let's take it one by one. If the parent sells goods to the subsidiary and add some profit to it, who enjoys the profit?
Parent.
If the subsidiary sells the profits to the parent and add some profit to it, who enjoys the profit?
The subsidiary.
Who enjoys the profit?
The subsidiary.
So the subsidiary enjoys the profits, right? So if the parent pay for that profit, the subsidiary will enjoy it. But at the end of the day, the subsidiary profit, where is it going?
To a parent.
Good. So how can you, okay, sell something to your son or your daughter? Meanwhile, you are the one who is going to give your daughter money to buy the thing. Does it make sense?
Not at all.
Yes. You see the point? So let's say your daughter likes selling clothing. Then you sell clothing. You give the clothing to your daughter to go and sell and added 20% profit on it. Then your daughter went out to sell the goods and your daughter sold 50% of the goods, but 50% is left. So the law says the 50% she sold, she should bring the profit. You enjoy it. You your parent, the mother will enjoy the 50% she sold. But the 50% that is not sold, should the mother still be keeping in the books that she has made a profit of 20%? Meanwhile, the daughter has not sold the 20%, the 50%. Can she do that?
No.
Yes. After all, if she's not able to sell the half of the goods, she returns it indirectly to your stock. So why should you still be keeping 20% profit on the goods that she is not able to sell? Does not make any economic sense. Does it look abstract or is clear?
It's clear.
Good. So that is why we are saying that. So what the daughter is not able to sell, there is 20% of profit on the goods that were not sold. That is what we call provision for unrealized profits. But the one she sold, the mother would take it and say hallelujah. No rule against that one. She would enjoy the profits, right? So our focus is on the one that is not sold. Now, if the mother was the one who sold the goods to the daughter, okay, the mother was the one who sold the goods to the daughter, okay, the unrealized profit, okay, is the mother who is going to enjoy it completely. Sorry, that profit is the mother who is going to enjoy it, the parent who is going to enjoy it completely. There wouldn't be anything, any enjoyment for non-controlling interest, the NCI who are having other interests in the daughter's accounts, because the daughter bought it from the parent. You see the point? So there is no remaining unrealized profit for NCI, non-controlling interest. However, if the subsidiary is the one who sold the goods to the parent and the parent hasn't sold the goods out at the end of 31st December, the subsidiary books is still keeping, for instance, 20% profit, waiting for the parent waiting from the parent's accounts. So if there is 20% profit from the parent account that is coming into the books of the subsidiary, as soon as 20% of that amount came from the parent, SCI will also enjoy the 20%. Is that not the case? Any profit the subsidiary make, the non-controlling interest people will also enjoy their portion. True or false? Right?
True.
So therefore, if it is a taboo for us to keep the profit that the parent hasn't sold as profit, then we must reverse that from non-controlling interest, because we assume that that profit is seated here. That profit is seated here. But the parent is not able to sell the portion of the goods that were given to him or her, then that profit that is not realized must be removed. So we look at the portion of the realized profit that belongs to NCI. So if the group NCI is 60-40, when we take that 20% of unrealized profits and we do the calculation, we must take 60% of it as a reversed. That is why this is in the bracket. It means we are taking it from the profit that has already been accumulated here. That profit, the unrealized profit, is not supposed to be there. We have to remove it. Then if you take 60% of it, quickly, 60%, so this is subsidiary to parent. So the same 80% that is left must also be removed here. Must also be removed. However, if the parent sells to the subsidiary, the NCI will not enjoy any profit because the profit goes back to the parent. So the NCI will not have anything to enjoy. So therefore, the 100% of the unrealized profit must go straight to the consolidated group retained earnings, and it affects only the parents. So in short, when the parent sells to the subsidiary, when the parent sells to the subsidiary, only group retained earnings will be affected and the inventory will be affected. So accounting treatment, when the parent sells to the subsidiary, you would have to debit group retained earnings and credit inventory because it's still in the inventory. That element of profit is still in the inventory. You have to go and remove it from the inventory and remove it from what? Group retained earnings. So when the parent sells to the subsidiary, you do two transactions, two accounting double entry. you will debit group retained earnings, which is this amount, okay, and you credit inventory the same amount. You will credit inventory the same amount. Now, if the subsidiary sells to the parent, okay, now it is no more two transactions. NCI will come in. So you will have to debit group retained earnings with the percentage that belong to the group, let's say 60%. And then you debit NCI with the percentage that belongs to the NCI, let's say 40%. Two will give you 100%. Then you will go and credit inventory. So two transactions, you still credit inventory in both. You will credit inventory. So when the subsidiary sells to the parent, but when the parent sells to the subsidiary, two transactions are involved or two journal entries are involved. So with the parent selling to the group, and you debit NCI with the percentage that belongs to the NCI, then you credit inventory of the total amount, 100%. I just hope you are getting what I'm saying. Are we still?
Yes,
Okay.
I think when we saw a practical example, I think it will solidify.
Good. All right, so that's now when it comes to group retained earnings, you are starting with the full amount of the parents. So the parent full amount, then the share of profit, we have already talked about it because the same share of profit, the percentage, so it's coming from workings 2. So this workings 2, you give portion to NCI, give portion to the group. Okay, so the group and NCI, they are just sharing it. They are sharing some figures. So you would do that. And then impairment loss. So impairment loss, I said that when it is NCI is fair valued, so you share the impairment loss between the group and the NCI. But if NCI is at proportionate base, the whole impairment loss is going to the group retained earnings. So you watch out for the method that is useful. So if the question is silent and doesn't say it's at fair value, any question that you solve and it's silent doesn't say it's at fair value, then automatically goes for the traditional method, which is at proportionate base. If they want you to do the fair value, they will tell you. If they don't tell you in a question, you go for what? The proportionate base method. Then we've talked about PEP. The unwinding cost is coming from workings 2 when you do the deferred consideration or contingent consideration, and then you will get the extra cost you will spend on. That gives you a unwinding cost. If it is 1 year, you find the difference. If it is more than one account, you just take the percentage, the cost of capital, and multiply by the amount that, if you do the discounting, the amount you get, you multiply by it. If it is 2 years and more, multiply by that, and then you get unwinding costs. You also subtract it. So you add this to get the group retained earnings, and that will go to balance sheet as here, group retained earnings 5, workings 5. Then you add the NCI, okay, workings 4, the total. The answer you get here, you still add it to the balance sheet, but you leave one line, okay, and then you add it to it here. If you like, in exams condition, no problem, you can add them together or everything together. Then you get that. That's all. Any question? So when I share it with you, you read, these are the forms of purchase consideration: cash, deferred consideration, then contingent consideration, then share exchange. There are some examples that you can look at. Then we look at goodwill arising from consideration, purchase consideration. We say goodwill can be negative goodwill, or it can be what? Positive goodwill. Okay, so negative goodwill, then it can also be positive goodwill. And we said if it is positive goodwill, you add it to the assets. Then if it is negative goodwill, it becomes bargaining purchase, or it's a gain. Then that one you add it to profit and loss account, right? Then we talk about non-controlling interest. Okay, and I said there are two bases or methods. We have at proportionate base or proportionate share of the subsidiary. So here, that is where you to look for the percentages and then you do that calculation. With a proportionate base, the impairment loss will not be shared between goodwill and the group. The whole thing goes to the group. Okay, that is that method. And then with that one, you won't see fair value of asset in workings 2. You don't have fair value of asset to the purchase consideration. But when you are done with the net asset taken over, NATO, you will take the percentage before you subtract it from the total purchase consideration. Then the other method is full value method or fair value method. If you don't see fair value, you see full, is the same thing. So with that one, you will start in workings 3 by adding the full value or fair value. The fair value will be given to you in the question. Always, if it is this method, it will be given to you in the question. So you add the fair value to the purchase consideration. You take the whole assets, don't take any proportion. Then you subtract it, you get gross goodwill. If there is impairment, you check, you do the impairment loss, you get net goodwill. Then you go to workings 3, 4, NCI, because fair value is at, NCI is at fair value. So what you do is that you would bring the impairment loss and share between the group and the NCI. And the fair value amount is what you begin with in the NCI calculation. Yes, in the NCI calculation. Okay. Then that is it. So we are done with this. So all the noise, we are done. Okay. So let's look at this question quickly. Then I will send you another, I'll send you this to look at. Right, I'll send you this to look at. Okay. Please, are you here?
Yes, please.
All right. Someone should read illustration 1 for us. Minta, please read.
Yes, please. Illustration 1. P company acquired 12 million equity shares of S Limited on the stock exchange at the cost of 17,200,000 Ghana cedis on 3rd January 2020. S Limited is capitalized with 50 million equity shares issued at 1 Ghana cedi per share. As at the date of acquisition, 3rd January 2020, the income surplus balance of S Limited was 3 million Ghana cedis. The individual statement of financial positions of the two companies as at 31st December 2020 were as follows. Stated capital, P Limited, 60,000 what I'm saying is in thousands. So 60,000, S Limited, 15,000. Income surplus, P Limited, 13,000. S Limited, 5,000. Total, P Limited, 73,000. S Limited, 20,000. PPE, P Limited, 50,000. S Limited, 18,000. Investment in S Limited, P Limited, 17,200. Net current assets, P Limited, 5,800. S Limited, 2,000. Total, P Limited, 73,000. S Limited, 20,000. S Limited has not issued any shares since 3rd January 2020. Prepare the consolidated statement of financial position of P Limited Group as at 31st December 2020. I'm done.
Okay, so I will help explained, and then I'll expect that you would solve this question, and then illustration 2. Okay, that is your assignment, illustration 1 and illustration 2. Okay, then next week when we meet, we would take so illustration 1, 2, and 3. Let me put it that way. So just try your hands on them. Then next week when we meet, after going through this, we'll pick a full question. Okay, then we calculate it. We pick a full question and do the calculation. Now, who is the parent company?
P company,
Who is the subsidiary?
S Limited,
Okay. What is the group percentage and what is the NCI percentage? Hey, you are searching for. Okay. What was the acquisition date?
first January 2020.
Yes, go ahead, please. And what was the reporting date?
Be 31st December 2020.
What? So the period is what?
1 year, 1 full year.
Okay. So what is the group and what is the NCI percentages?
Please, the group, I had a percentage of 80, and therefore the NCI will be 20%.
Okay. That's good. Now we are done with workings 1. So let's move to workings 2. Workings 2, we have at acquisition and at reporting. So what comes first under acquisition? I'll give you the format. So what comes first? Workings 2.
Yes, please.
Is this
Stated capital.
So what's the stated capital amount for acquisition and reporting?
Acquisition is 60,000 and the reporting is
In this
8.
case. Hmm? Can you?
Yes, please.
Yes, sir.
So I told you that workings 2 is of net assets of what? What's the name?
Subsidiary.
Yes. So everything about workings 2 should be subsidiary, and subsidiary is S. You see, it's S. So if I ask, what is the stated capital? What will be the amount? Or you can see my screen.
Yeah,
15,000.
at acquisition 15,000.
And reporting. Is it not the same figure?
Yes.
Yeah, it's the same.
Good. So that's it. What is the group retained earnings at the beginning of the year?
You subtract.
So we can go for income surplus. So on 1st January 2024, income surplus, okay, was 3 million, right?
Yeah.
It's different from capital surplus. This is income surplus, different from capital surplus. So this is another name for group retained earnings, right? Or profits. That is income surplus. So at the beginning of the year, how much was the group retained earnings?
Group retained earnings. That was the percentage was 80.
I just said it right now. I said income surplus is the same as group. So
3
what was
million.
the 3 million? What was the group retained earnings at the end of the year?
3 million, yeah.
What was the retained earnings at the end of the year?
Is it 5,000?
There are zeros on top, so you can complete it.
So 5 million.
Yeah. So at the beginning it was 3 million, at the end it's 5 million. So what's it? How much is going to profit as the difference? Post acquisition profit is how much? 2 million.
2 million. 2 million.
Yes. In the format, what is next?
Fair value asset.
So in this question, no asset has been fair value. They didn't tell us anything, right? So you ignore it. Then what is next? If there is no fair value, there is no what? Depreciation. Is that not the case? And no brand. No brand has been given to us, right? Is that not the case?
Yes, sir.
Good. So you just conclude this one. And then that is all. You move to workings 2. Workings 2, we said we should start with purchase consideration. In this case, did they tell us any purchase consideration?
Yeah.
How much?
70 million.
17.2 million. Good. How many types of purchase consideration are in this question? Or which ones are you seeing in this question?
That one, I can see one.
Is that?
I can see one, that of cash.
Cash, that's all. So ignore the rest. The rest are not there. Is NCI at fair value or not? Or is silent? Have you seen any NCI information here? Is it silent or is at fair value? That is all the question. So it's silent, right?
Yeah, it's silent.
So if it's silent, which method are you using?
Proportionate.
Proportionate.
Proportion. Good.
Okay.
Then you know what you do with the proportion. So you do the calculations. They didn't tell us whether goodwill is impaired. So therefore, there is no impairment of what? Goodwill. You do the calculation, get your goodwill. Then NCI ESF workings 4. We are going. Workings 4. Since NCI is not fair value, we start with the percentage of NCI that we got from workings 3. All right. So workings 3 percentage that we have gotten. So that will be 15,000. 15,000 plus 3,000. That will be 18%. And then the group is, you said 80%, right?
80. Yeah.
Yes, the group will be 80. NCI will be 20. So 20% of 18 million, that will start with workings 4. Okay. Then the percentage profit that you have gotten, the difference between 3 million and 5 million, if nothing is added on, the NCI will get 20% of the 2 million. The group will get 80% of the 3 million. Then there is nothing again for NCI. You go to workings 4. Workings 4, you start with the parent profits. The parent profit is 30 million. Then you add the percentage that you shared, which is 2 million. The difference between this 3 million and then 5 million. 2 million. 80%, you add it. Then there is no unwinding costs. Parent, no one sells to another here. There is no parent or subsidiary selling to that. There is no deferred consideration, though. There is no unwinding cost. There is no impairment lost. There is nothing again. You just conclude. That's all. And you balance it. To balance. Are we safe?
We are.
Okay. That is it. So it's a small question for you here, but you can use all the workings. Where the information is not there, you leave it and go on. Okay.
Okay.
Good. So look at this small question. Look at this small question. So here, the requirement is to calculate goodwill. But before you can calculate goodwill, you have to do workings 1, 2, and before you go to the 3. Calculate NCI, then also group routine earnings. So the question is just saying, do all the workings. How many workings did I say we have?
5.
Good. So do all the 5. Do all the 5. Okay. So that is it. Every information you have done is in this question. Every information you have done is in this question. You don't have to worry yourself with doing all the, what do you call it? If you can't do all, you can do some, right? You can do control structure, you can do net assets of the subsidiary, you can do goodwill. But if you can't do NCI or group routine earnings, you can do some, but don't leave it like that, okay? Do as many as you can, or as much as you can, right? Then leave the rest. Yes.
All right.
So shall I leave it so that you will go and look at that? You can
Yes.
you can do your own discussion and then look at that. So I can 2. So it's very simple. Look at it. On 1st May, so you know acquisition date is what? 1st May 2018. Chanty Limited acquired 60%. The NCI is what? NCI is what? Hey.
40%. 40.
Yes. Of the equity in Nathan. Who is parent? Who is subsidiary?
Chanty is parent.
Good.
Nathan is
Good. A public limited company paying 120 million immediately in cash. So which type of consideration is that? Hey,
Cash.
you people, you are thinking too much. And then an additional 44 million on 1st April 2019. That is 1 year later. And full stop. So what kind of consideration is that?
Deferred.
Good. Why no contingent?
There's no condition attached.
Good. The fair value of the identifiable net assets. So this one is a new thing for you. Acquired was 220 million at the acquisition date. Now this one tells you that the total of acquisition. Do you remember the acquisition in Workings 2? Acquisition dates. Do you remember? Hey.
Yes, please.
Acquisition date, the total. Look at it. I want to show you.
At acquisition, okay.
Good. This total, this total one, the red one, is 222. Please, are you getting what I'm saying? The net identifiable asset, that is the total for this acquisition date. So it means you must look for stated capital, you must look for retained earnings, you must look for fair value of asset, okay? You must look for brand, and you must look for stated capital surplus. If they are not there, and you get stated capital, you get retained earnings at the beginning. And then the question says that, but the two, when you add the 2 or the 3, it's not up to, it's not giving you 120, 220. They are saying the difference, okay, is some assets, maybe land or building or PPE. So you come and put that difference here. So this plus this minus 220 should give you the difference. So look at what they are saying. The fair value of the net identifiable net assets acquired was 220. So when you do your calculation, you must get the 220. If you don't get the 220, okay, excess of the fair value of the net identifiable assets at acquisition was due to what? Was due to what? Was due to what?
Non-depreciable land.
Good. So they are telling you that the difference, the reason why the figure is not adding up to 220 is because there is what? Land. The difference is as a result of land, and that land should not depreciate. So we wouldn't have depreciation here. Have you seen the trick? Right?
All right.
Okay,
Yes,
so yes, that is it. So we continue. The fair value of NCI, have you seen? So which method of NCI is this?
Fair value.
Good. And they've given you the 90 million. You know where you use it. You use it in Workings 3 and then Workings what? 4. Where necessary, the cost of capital of Chanti is 10%, and then Nathan is 12%. So where will you use the cost of capital? To do what? To do the discounting in Workings 2. Is that not the case? Deferred and contingent. Don't you use cost of capital to do? So please always use the parent. Don't use the subsidiary. Okay? Use the parent's cost of capital. No subsidiary. Chanti uses full goodwill method. Another name for full goodwill method is known as what? Fair value. Do you remember? Hello?
yeah, yes.
Good. Then the share capital and retained earnings of Nathan were this. So this is share capital, stated capital of Nathan. At the beginning, the retained earnings 130 at the beginning. So you see that they have given you the beginning they give you the stated capital and the retained earnings, and the other components of equity. So these other components of equity of 12 million should be treated the same as stated capital. Okay, this will help you in workings too. Then the excess of fair value of, and we have read this, so the difference, okay, should be as a result of land. So if we add stated capital 120, so let's add a 50 plus 130 plus 12. What are you getting? 50 plus 130 plus 12.
192.
Good. 192. And they said the total should give us how much? The total should give us how much?
220.
Good. So what is the difference?
28.
So 28 is what? They said we should use 28 as what?
Non-depreciable land.
Good. That is it. So you see, consolidation is an interesting topic. Very interesting. It's like mathematics kind of things adding to accounting. So that is it. They are telling us everything in the question. Everything is in this small question. If you like, right, I can set this as your exam question. But anyway, let's go. Then the goodwill has to be tested for impairment annually, and at the end of 30th April 2019, had reduced in value by, what is the impairment loss percentage? 20%.
Okay.
Now you know goodwill is at fair value. So if there is impairment lost, portion of it to go to NCI and portion of it to go to group retained earnings. Take note. Assume that at the end of 30th April 2019, which is the date that you are preparing your financial statements. Okay, that is the acquisition date. Yeah, the reporting date. Chanty retained earnings. So this is the closing retained earnings. Okay, so if the opening retained earnings is so Chanty is 200 and Nathan is 180. So if the closing retained earnings is 130, if the opening retained earnings is 130, and the closing retained earnings is 180, how much profit have they made in a year? How much profit?
50 million.
15 million. And during the year, Nathan sold goods. You see this, we are coming to a realized profit. Nathan sold goods of 8 million to Chanty for 10 million. Who is selling to who? Parent or subsidiary? Selling to who?
Subsidiary selling to parent.
So if subsidiary sell to parent, what are the accounting treatments? You have to know it at the transaction, 3 treatments. A parent selling to subsidiary, there are 2. So now subsidiary selling to parent, what are we debiting? Group retained earnings. And what again do we debit? Or you don't have confidence?
Nathan.
So you debit group retained earnings and credit and debit, sorry, you debit group retained earnings and debit NCI and credit what?
Inventory.
Good. So look at something. Nathan sold goods costing 8 million to Chanty Limited for 10 million. You get it? So how much profit did Nathan put on his 8 million? How much profit? 2 million. At the end of the year, half of the goods were still in stock. So if half of the goods were still in stock, it means that half still contain unrealized profit. So how much is the unrealized profit in the half?
1 million.
Good. That's all. 1 million. Nathan normally charges the markup on his goods. Okay. But in this case, you know that 1 million is what is left. Okay. 1 million is what is left. So they shouldn't enjoy the 1 million. Do the reverse, you should remove the 1 million from it. So what's the percentage? Nathan, the group is 60%, NCI is 40%. So 60%, okay, of 1 million is 0.6 million. 40% of 1 million is 0.4 million. So just do the interest. You debit group retained and is 0.6 million. You credit NCI 0.6 million, and you debit, you debit group retained and is 0.6 million. You debit NCI group 0.4 million. You credit inventory inventory 1 million. That's all. So please, I will send this question to you. Okay. Shall I add a solution or should I add a solution?
Please add everything. And please bring it in the exam so that we can score.
I'll bring the exam. It won't be the same question. It will be similar question. But I don't want to bring this one. I want to bring the one that contains the balance sheets. But this one, if you understand this one, the one contain balance sheet, there's cocoa for you. Because all this information will be there. But the balance sheet will still be there, right? All this information will be there. That you doing the workings, you do the balance sheets. All right. I think we are done for today. Any questions?
Yes.
Okay.
Any question?
No question, please.
All right. So please have a good day.
Thank you.
Thanks and same to you.